The quadrillion-dollar derivative bubble, the mathematical proof that your money is actually someone else's debt, the number that breaks your brain. Visual: a black screen with a single white number ticking up rapidly. It crosses millions, billions, trillions, then hits $1 quadrillion. Host: there is a number so large that the human brain cannot actually process it. It's not the US national debt. It's not the GDP of the entire world. Host: it is the estimated notional value of the global derivatives market. Depending on who you ask, the Bank for International Settlements or independent analysts, this figure floats between $600 trillion and $1 quadrillion. To put that in perspective, if you stacked 1 quadrillion pennies, they would reach past our solar system. Host: but here is the mystery. There is only about $80 to $100 trillion of actual money, cash, and digital deposits in existence globally. So, if the financial bets on the money are 10 times larger than the money itself, what happens if everyone tries to cash out at once? Visual, dramatic montage of the 2008 Lehman Brothers crash, followed by headlines of Silicon Valley Bank collapsing in 2023. We are told the banking system is safe. We are told 2008 was fixed, but the math tells a different story. Today, I'm going to show you the mechanical skeleton of the banking system to prove two terrifying things. 1. The quadrillion-dollar bubble is real, and it's hiding in plain sight. And 2. The money in your bank account isn't actually money. It's a legal IOU for debt that someone else owes. Buckle up. We are going into the balance sheets. The stage. What is a derivative? The casino of everything. To understand the bubble, we first have to understand the weapon, the derivative. The financial media makes this word sound complex to keep you from asking questions. But it's actually very simple. Derivative is just a contract that derives its value from something else. That's it. It is a bet on the price of a thing without owning the thing. Let's say you are a farmer. You grow corn. You are worried the price of corn will drop before harvest. So, you sign a contract with a banker. If the price drops, the banker pays you. If the price rises, you pay the banker. This is called a futures contract. It's a derivative. And originally, it was a brilliant invention. It's allowed producers to stabilize the world. But then, Wall Street realized something. You don't have to be a farmer to buy that contract. You don't ever have to touch the corn. You can just bet on the contract. And then you can create a derivative of that derivative. Bet on the bet. Suddenly, a $100,000 house can support $10 million in derivatives bets. This is what we call financialization, and this is where the quadrillion comes from. It is the notional value, the total face value of all these bets combined. And the vast majority of these bets aren't on corn or wheat. They're on interest rates. Keep that in mind. Interest rates are the pin that pops the bubble. But to see why, we have to go back to when the math changed. The origins and the equation. The modern derivative market wasn't born in a bank. It was born in 17th century Japan at the Dojima Rice Exchange in Osaka. Samurai were paid in rice, but they needed cash. So they sold rice tickets, promises of future rice. These were the world's first futures markets. It worked because it was backed by physical rice. Fast forward to 1973, two mathematicians, Fisher Black and Myron Scholes, published a formula that changed the world, the Black-Scholes equation. Shutterstock, this formula allowed bankers to price options, a type of derivative, with mathematical precision. It gave them a feeling of invincibility. They believed they had solved risk. With this new confidence and the deregulation of the 1990s, specifically the repeal of the Glass-Steagall Act and the passing of the Commodity Futures Modernization Act of 2000, the banks went all in. They stopped being utility companies that stored your cash and became hedge funds that gambled with it. They built a mountain of derivatives so complex that even the CEOs didn't understand what was inside them. And that brings us to the moment the world almost ended. Act 2. The breaking point, the 2008 rehearsal. Most people think the 2008 crisis was about poor people buying houses they couldn't afford. That is a lie, or at least it's only 10% of the truth. The crisis was caused by the derivatives built on top of those houses, the credit default swap CDs. Credit default swap is an insurance policy against someone not paying their debt. But unlike normal insurance, you don't have to own the house to insure it. Imagine your neighbor has a house. You can buy insurance on it burning down. In fact, the whole neighborhood can buy insurance on it burning down. If the house burns, the insurance company doesn't just pay the owner, they have to pay everyone who bet on the fire. In 2008, a company called AIG had written trillions of dollars in these derivatives. When the mortgages went bad, AIG owed more money than existed in their accounts. This is the counterparty risk. A derivative is a contract between two people. If the loser of the bet goes broke, the winner doesn't get paid. The chain snaps. In 2008, the government stepped in and printed trillions to patch the hole. They saved the banks. Odd. But this is the twist, they didn't remove the derivatives. According to the Bank for International Settlements, the market is larger today than it was in 2007. Why do we allow this? Because of the nature of money itself. Act 3. The mathematical proof money equals debt. Now we arrive at the core of the mystery. Why is the system so fragile? It's because of how your bank account works. Most people assume that when you deposit $1,000, the bank puts $1,000 in a vault with your name on it. That is false. When you deposit money, you are legally lending it to the bank. Let's look at a bank's balance sheet. In accounting, the golden rule is assets equals liabilities plus equity. To a bank, your deposit is a liability. They owe it to you. So what are their assets? Their assets are the loans they give to other people. When you take out a mortgage, the bank doesn't give you someone else's money. They simply type numbers into a computer. They create the money out of thin air. This is the mathematical proof. Bank asset equals your promise to pay the mortgage. Bank liability equals the new money in your account. Money is debt. They are two sides of the same ledger entry. If all debt was paid off tomorrow, all money would disappear. This is called fractional reserve banking. The bank only keeps a tiny fraction of actual cash reserves to cover daily withdrawals. The rest is lent out. Shutterstock. So we have a system where money is just a digital record of debt. Banks use your deposits to fund these loans. Then, they use derivatives to bet on the interest rates of those loans. And this is where we find ourselves today. Act 4. The modern trap, the interest rate spike. Remember the quadrillion dollar bubble? I mentioned most of it is interest rate derivatives. For 15 years, interest rates were near zero. Money was free. Banks loaded up on long-term bonds debt that paid 1% or 2%. They hedged these positions with derivatives. On camera then, in 2022 and 2023, the Federal Reserve raised rates faster than at any time in history. Basic math. When interest rates go up, the value of existing bonds goes down. Suddenly, the safe assets on the bank's balance sheets, the bonds crashed in value. This is exactly what killed Silicon Valley Bank. They had to sell bonds at a loss to pay depositors. But the bigger danger is the derivatives market. Banks use interest rate swaps to protect themselves. But remember 2008, a swap only works if the other guy can pay you. If we have a $1 quadrillion market and rates move violently, the margin calls, the demand for cash collateral become astronomical. The notional value is hypothetical, yes, but the liquidity needed to service it is real. If a major derivative player fails today, like Credit Suisse almost did, the dominoes are much bigger than in 2008. We are living in a system where the insurance on the market derivatives is 10x bigger than the market itself. Conclusion, the 3 takeaways. So what does this mean for you? You aren't a hedge fund manager. You just have a savings account. Here is the reality. 1. Your money is unsecured debt. When you see a balance in your banking app, you are looking at an unsecured loan you made to a bank. If that bank fails due to a derivative blow-up, you are a creditor. You are in line with everyone else. 2. The safety is an illusion. The FDIC insures deposits up to $250,000, but there is only enough money in the FDIC insurance fund to cover about 1.3% of all insured deposits. If a systemic crisis hits, the math simply doesn't work without printing trillions of dollars, which leads to inflation, devaluing the money you do have. 3. The bubble can't be fixed, only moved. Since 2008, we haven't reduced the debt or the derivatives. We transferred them from private banks to the public balance sheet, central banks. I'm not telling you this to make you panic. I'm telling you this so you understand the game. The system is designed to leverage debt to create growth. It works until it doesn't. The quadrillion-dollar figure isn't just a scary number. It's a measure of how leveraged our future is. It is a monument to the idea that we can mathematically eliminate risk. But as history shows, from the rice exchange of Osaka to the trading floors of Lehman Brothers, risk cannot be destroyed. It can only be transferred. And right now it's been transferred to you. Visual host returns to center frame, and the background is dark. If you want to understand how to protect yourself when the math finally corrects itself, you need to understand more than just banking. You need to understand assets that don't rely on someone else's promise to pay. I'll be doing a deep dive on bearer assets in the next video. If you found value in this breakdown, hit the like button so the algorithm shares this knowledge. And subscribe if you want to see what the balance sheets look like after the crash. Thanks for watching.